Obviously, yesterday should have been pretty clear to you guys, at least the finish, right? The in between was kind of messy, but you guys should expect this now that the gamma profile is pretty much devoid of any meaningful support or constraint or whatever you want to call it. No longer do we have any kind of suppressive flows as far as containing volatility. It's actually today flipped into what we call accelerant flows, which are negative gamma beyond just local gamma. Oftentimes we have negative gamma kick in maybe like in the last couple of minutes due to color because zero-day options become really powerful at the end. But today it's different. You'll see in just a moment. I'm going to switch my screen over to the slides and carry on with the meeting as normal. Okay, so hopefully you guys feel well prepared for the trading environment. I've kind of, not to say I can call it all the time, but it was clear that for whatever reason, Feb OPEX was going to be a local top. Right. I know I'm not the only one who saw it this way. There were some who called a blow off top, but I think, Jem also to his credit this time spotted it correctly. He's pretty good on timing. Hopefully he did well this time on execution as well. But it was pretty clear that a lot of the grind up in February was very similar to what we experienced in February of 2020, where despite news, despite headlines, whatever you want to call it, nothing could really shake the market. And all of a sudden things change instantaneously. So little preview of recap of yesterday. The red up top here is obviously reflecting negative gamma. You guys saw for yourself how vicious the price action was all in this range here. This is what you can expect when gamma is not present. Usually we know we have market makers kind of providing a cushion really throughout all of the range, but you guys have seen day after day after day, both as inventories drop, which you can see in the options depth positioning, but also as straddle prices increase. Two things going on, right? Oftentimes they're correlated because inventory is dropping, meaning specifically market makers less long zero-day options literally does mean that straddle prices should increase, right? Because they're price sensitive or they're inventory sensitive. They respond to inventory. So as this all happens, options have less gamma to begin with, and the fact that they're not long as many and actually wind up short some, you can see that the character of the market is completely different, and this is visible through these gamma profiles. Yesterday's action was pretty vicious. I would not have described what happened at the close as directly coming from charm. As you guys know, if you're new here, I'm going to try to be a little more clear, but there's a lot of things I say all the time, right? This framework here, you have to understand the duality of options. So gamma tells you how market makers interact with other flows. That's very important. It takes somebody else to get the ball rolling first before a market maker is going to respond to it. Now they're going to respond by doing nothing if they're neutral. If they're long gamma, they'll act in a way that supports the market on a sell-off or constrains it on a rally. And additionally, negative gamma obviously is the opposite. They're price takers. And if you don't know about market maker systems, they're fast. You cannot compete with them. They beat you to the offer every time on a rally and vice versa on a sell-off. And so you see what happens in negative gamma, very different. Charm is unique in that it does not require anyone to get the party started. It just requires the clock to advance. And the clock advances across all options. I guess there's some asterisks there with respect to events and certain decay profiles. But for basic understanding, just know that charm is in motion all the time. And it's the one thing that can actually set a trend without anyone else trading. If no one else came to play, market makers would define the price action entirely. So you can think of charm as defining like an equilibrium background track. It's pretty important and valuable because instead of having this kind of, excuse my term, bullshit notion of a random walk, we now have basically a prescription for what would be happening if nobody else traded, right? Yesterday, I would not describe this as charm, but you can see what happened locally at the end of the day. Now, this is kind of messy here. I'm not going to zoom in entirely, but even in the RTM room yesterday, so I talked about certain option plays, trading 58.15 or 58.20. You guys probably saw how expensive the zero-day options were yesterday, and they'll be the same today. It gets more difficult to do things. You might not want to just go ahead and pay $9 or $10 for a $10 out of the money put with an hour and a half or 2 hours left. But if you know where you're likely to experience some pressure constraining the market and supporting it, like we knew yesterday with this iron condor, and again we have one today, you would have known that 57.80 was a natural stopping point conditional on a sell-off, right? So it didn't land perfectly. You guys should also expect that as vols get higher and we have less book depth, these are not going to be as precise of outcomes, right? So in the summer, for example, when things were very, very low vol, very, very high gamma, extremely high charm effects around the options at the end of the day, sometimes we've had pins within pennies. It's going to be different now, but you should still have an ability to hit home runs with this data. 57.80, for example, instead of paying $10 for the 58.10 put and tripling up. You could have paid $2 for a 15-point fly and paid out nearly 6 to 7x. Little variance along the way. And obviously, I always recommend kind of unloading some of your winners early. But if you play this the right way, you get a lot of double ups, triple ups, and eventually some grand slams. Return to mean has been great. If you guys are aware, we have 8-day trials now, not 5-day. 8-day allows better onboarding. It's been pretty valuable with levels and also end of day signals. Have had pretty good success, and we're probably about halfway, I would imagine, through the room capacity. So I just want to let you guys know that we will be closing it eventually, but we do have trials available for the moment. Overnight range, obviously, you guys, if you follow me on Twitter, you see that I have been a little bit bearish lately. 58.15 seemed like a line in the sand to me. I mentioned yesterday I did not expect this, whatever you call it, session with Congress, State of the Union. I did not expect it to be a bullish impulse. We know Trump. If you've been paying attention, you should be aware that he has not really mentioned the market. This should be a signal to you, right? He's mentioned crypto for some reasons, but he hasn't really talked about stocks or S&P. He's not really demonstrating the same focus as he did the last term. Been saying this over and over. Trump 2.0 is very different. He doesn't have the same set of constraints, and obviously has the public kind of at his back this time. And so you should expect more vol of vol. It's a structural bid to vol of vol. And I don't think he cares as much about getting stocks to 6,000 or 7,000. Be it as it may, we saw there's some noise about like a Ukraine deal. I don't think we're at a tradable bottom yet with respect to podcast question. It's getting close. I do believe it's getting close. I was mostly mentioning in my tweet with the Gamma profile that you see this type of noise and abstract looking picture when you get to levels where the straddles are getting very expensive. You know, we had some notes yesterday. Somebody in the Discord pointed out, I think it was Steph who pointed out that, and maybe podcasts as well, that there are some ratios and signals in the VIX complex that are flagging short-term bottoms, maybe intermediate-term bottoms. Personally, I do not necessarily think we're there yet. I'd be looking towards NFP or CPI before really looking for a reversal, just because it's a more natural stopping point. Although I do think the month of March is a bit of a trend down one. I'll talk a little bit more about this in the VIP mentorship room midday today, because I think it's important to look at systematic positioning at this moment and also talk about where we would need to go for the entire case to kind of change. There's a good case for a mid-month bounce, and there's also a good case for a really grinding, devastating rally pushing through to the end of the month. And at that point, maybe changing character, but that will depend, in my opinion, where we get to first. So yesterday we bounced off the 200-day moving average. Today we'll see what happens. Now, this is not Groundhog Day. It should look familiar though. This is very much like yesterday's morning meeting slide for an obvious reason. You guys should know very clearly who this is at this point. I think it's funny. I had some people asking me questions about this yesterday who I would have imagined are very keen on this. But on the institutional side, it's becoming picked up on as well because the sizes are big and they're also standing out significantly, right? Because in a sea of negative gamma, there's this lone wolf customer who seems to be, doubling, tripling down, and they're kind of size agnostic. They're not looking at volatility in the same way. They're just executing the strategy as is. So we're going to see this position probably come into play again as far as tradable levels. Important to point out, just know that higher volatility options are similar to longer dated options. When you look at these 5-point spreads, I used to laugh at the idea that these could have any impact at all, because when vols were even a little bit higher before 0-day pressure became such a prominent thing because the selling really overtook any of the other near-term flow, these spreads that are 5-point wide would have virtually no impact, because when you look at it on any higher vol, it's not going to be very local until the end of day and near the strikes. What I mean by that is right now on these vols, there's almost zero gamma coming from the 5700, 5705 put spread. Why is that? Because they're virtually identical options. If you look at the deltas, they're going to be effectively the same. So they're on the same point of the distribution, they're fungible. When you drop volatility significantly and have lower straddle prices, which we're far away from at the moment, they actually do have Greeks. The Greeks become local. And that's what we've been used to really over the better part of the year. But now it's not going to have any real effect until the end of day. It might be somewhat impactful if there are firms that are really only trading 0-day options. Like yesterday, I had a lot of inbounds from guys at high frequency firms, or two actually, asking me the specific same question. Did I see anything strange in 0-day skew? You'll notice that these options, yesterday, for example, was strange. You probably noticed yourself that at one point when we got towards the lows, 0-day skew probably flipped to call or got very close to it. It's natural because you have vols get really high. You also have a situation where market makers just don't want to carry this position. There's nothing in the world that is compelling about sinking down 100 and whatever odd dollars into a position that's highly negative speed. Another way of saying that is short 0-day Vanna, like long options below us on higher vols and short them above us on lower vols. That's a miserable position. That gets adjusted very quickly. Market makers are very responsive to these things. And probably you notice that skew is flat or maybe to call at some point. You may see effects like that. Don't expect a lot of local gamma just because of this position. You saw yesterday too, when we got to the iron condor, it was not like it was in other periods, meaning the level did not hold as strongly, right? There's a reason. It's because literally the options don't have as much gamma. When I say Greeks become local, just the question in the chat here, what I'm talking about is that it's only sensitive, or the Greeks are only really present or visible when we're trading by the strike, right? And I guess that's a little bit subjective, but you can kind of understand what I mean. By the strike and farther towards the end of the day on this chart here, you're going to notice more effects like this is local. This time of day between 5720 and 5700, that's what I mean by local. You see that the character here, much more long gamma than you have here, right? So that's what I mean by local. Local is just very strike sensitive in a certain particular range is what it is. Basically, it's an expensive straddle. This is higher than we've seen for CPIs, NFPs, etc. This is just a function of positioning and the fact that market makers are getting shorter and shorter gamma in this range. And obviously the realized vol both on a close and tick basis is exploding. So this is taking people out of market and also probably drawing people into using these instruments for the gamma right now. But it's just a different character right now. Negative gamma. This is what I was talking about this morning in my tweet. This is almost looks like an abstract painting, right? So we're seeing a lot more negative gamma, and it's throughout ranges now, not just local at the end of day. It used to be typical to kind of see things like, imagine this little mark here was all red instead of blue. Typical sometimes to see the effects, again, locally at the end of day become negative because of a strike, but now it's like the entire profile. This is reminiscent of like October of 2023, right? Or like that moment in Halloween. Again, at that time, the Bank of Japan and the yen was a big deal as well. But that moment before the rally, where we have negative gamma above us, we move through it just as quickly to the upside, oftentimes quicker than the downside. Not saying we have to bounce today, but I am saying that when we do have a tradable bottom, it's going to be fast. And then you have a whole bunch of knock-in effects, right? So first you want to see systematic positioning exhaust, which we're seeing happen as we move along. Then you want to have a position where you have a lot of negative speed, which is gamma support to the downside and less resistance to the upside. And negative gamma is a pure case of this. Like this is the opposite of the dealer position we're used to, meaning it's a long risk reversal from a dealer perspective is long a put, short a call. Usually dealers are short risk reversals because customers hedge. This is the type of position that when we find a tradable bottom, when we have systematics reloading, when we have passive reloading, like we saw in end of February, for example, with pensions at the end of the day, that type of behavior will set the ball in motion the other way viciously, right? So just keep that in mind. I don't think we're there yet, but I could be wrong. Just if you're trading intraday, play the profiles as they come. But if you're looking for a wider time frame setup, you're going to want to look for these big kind of moments where we should have vol relax. The position should be somewhat like this, and you should have a reason to expect either passive inflow like pensions or systematic inflow, because those are the types of flows that happen in sizes that can really move the needle. And again, this is very much like yesterday. The did you guess right is because I've been doing kind of like quizzes in the morning instead of just telling you guys the answer right away. But the point is that gamma and charm, they're all related and they come from the positions that you see. It helps to see the position first and then work your way through creating the profile in your head, because that's how you learn it, right? And so the gamma profile and the charm profile are related. There's kind of a duality here. Like I talk about all the time, gamma defines how the market interacts, market makers interact with other players. Charm defines how market makers have to behave just as is, holding everything else constant, but advancing the clock. So here we have passive selling flow dominating. The caveat, again, is that this is passive selling flow. This says things decay. Well, we have two things going on here. We have a lot of trading going on, not a lot of gamma. So don't lean on this in the beginning. You never want to look at this and say, oh, what happened? We're supposed to sell off because of passive selling flow. No, you still have to pay attention. You still have to be an active trader and kind of take the pulse of the market. Understand when there's a lot of flow, you don't lean on charm. Charm is best leaned on when things become slow, a little bit dry. And occasionally, we may have a good opportunity to lean on charm aggressively on, let's say, Thursday because of the NFP, where it's typical to see people just kind of wait and see. And then obviously Friday, for the active VIP guys, I will do the typical econ preview. It might be a good one this time because there's going to be a lot of hedge release or a hedge, completion, truing up, whatever, into that number from pretty high vols. It might be a powerful move on Friday morning. And as you know, we do these previews for a reason to show you guys what is likely as a base case when that data comes out. Because whenever a known unknown becomes a known, regardless of the outcome, there's a vol drop move that happens, and it can be very, very powerful, very, very precise, and almost like free money if you understand how to do it. So I'll put that together Thursday night, Friday morning for the mentorship. So higher vol, less gamma. Just a question quickly, then I'll move it over to trading close to talk about the RTM room. Higher vol, less gamma, less pressure on dealers to hedge, in the sense that dealers are not providing liquidity. Yes. So if dealer hedging is providing liquidity because they're supporting the market on a sell-off, selling futures on a rally, that constrains the market to some degree. When there's no gamma present or when the vols get too high, the straddles don't really have any gamma. It's almost like you're taking a 0-day option and making it a 2-week option, right? So now it's very different. Now it doesn't have the same gamma that we're used to. Dealers won't be as sensitive, and you'll see that as the profile kind of disappears. If you were to just take a scaler and have the same exact position, let's say you're able to slide the scale up and down on the vol surface and make straddles more expensive or cheaper, you would see very quickly how this works. You'd see the options that profile go from like deep blue to virtually white as you raise volatility. Another thing I want to point out before I move it over to trading close, I'm going to add him as a speaker. And then just note there was some interesting flow yesterday. We talked about the IC whale, or Captain Condor, as Spot Gamma has termed them. Those guys have been prominent, obviously, and their positions are very worth paying attention to. But one of our favorites, the IB whale, came into play yesterday. We'll see what happens with him. Buying March call spreads, 59.61 call spread. So we'll see if that pays off. Obviously, usually I think he's early. That's been my traditional interpretation. And I think, again, probably my interpretation this time too. We also had a huge buyer of, I think, March 11 straddles. It was a screen bid, but I think by the end of the day, they accumulated over 1,600 to 2,000 straddles. So just be aware there's a lot of hedging at the moment. We'll have to see what happens, but I think we're not quite there yet. I'd look towards NFP or CPI. He should have the power to share his screen.
All right, we're close to an open, so I'm going to go quickly. I know that there seems to be a lot of folks in here, which is really great. Thank you. Happy that you're here. This was going to be a presentation that we were going to do inside the RTM room, but we swapped it to do it here just to give you guys a little bit of a view. There's going to be a bunch of terms and shorthand that we use that probably won't make sense. This is not necessarily a pitch for the for the RTM room, but really the only way to really kind of learn to understand what we're talking about is to jump in for a trial. So I do apologize if some of it doesn't make sense. It barely makes sense to us. Okay, so this is yesterday's back half of the day. We had a morning line print up here, right? And that was a very late one, as everyone remembers. And then we have the afternoon line. It was an early one. As you guys know, sometimes we can always, there could be a tiny bit of a question. Was it a correct print on the afternoon line? But as you can see, as you guys remembered, we kept getting signals saying, there's no balance up here, there's no balance up here, there's no balance up here, which usually to us means that it was going to come back to the afternoon line, which it exactly did. Not only did it come back, but it had a pretty good bounce off it. So, and as you guys know, what we're looking for, right, is when these drive backs is something that looks like someone pushing towards that exact spot and then turning off, right? So that could look like lots of different things, but obviously that's what this looks like here. Turned off, boom, bounce. So really, really good afternoon line. Stevie and Stephanie would have been very happy with that. What's interesting is, obviously, as you saw, we ripped away. Stevie and Stephanie made a what looked like, that was not nothing, 10, 15 points. It looked like a good push because clearly there was not only a lot of size, there was a lot of size pushing down towards just a blind sell-off. It didn't even look like they were really targeting much. I know we got really close to the morning line. I'm going to talk about that in a second. It really just looked like a blind sell, right? And so that was a very impressive, I guess, push for 10 points. But, they lost it. It went far away. And that's it. The afternoon line missed on that day. Even TC 1.0 was overwhelmed. That's how much selling was. And that's a thing we talk about a lot, right? It's going to be occasionally very large size that comes along, and that large size is going to win. Okay, so I know what the next question is going to be. I know we spoke about this a little bit in a few minutes after close, and then we had a close that looked like this, right? So it started to reverse back, and not only did we donk back, we did our favorite to the fucking tick donk backs. We did look at this 1, 2, and then stopped, right? To the tick. Something that looks like, as we just said, someone pushing to an exact spot and then turning off. Well, that's what that looks like. Not only did we have that, but then we had a morning that looked like this. We had a morning that looked like this. When I left the note in the RTM room, we'd got down to 84. What was that, 84? And I was like, oh, that's actually pretty close. We'll just call that close enough. Since I left the note, we did a hard donk at it and bounce away from it. So that confirms it even more, right? I know a lot of y'all will say to me, can we use these the next day? Can we use them forward? Are they relevant into the future? The answer that I give you guys all the time is that these signals will go stale the second cash closes, simply because the primacy of the decks that we're tracking are heading towards a very specific moment of time, and that's when the swaps execute at close. And so they're looking to get flat or get off risk by then and be done, and then they turn off for the day. They restart again once we reopen in 2 minutes. What is interesting, though, is clearly, right, we can see a drive towards it. So I want to say like this. There was a comment put in one of the Quanti group chats I'm in, and I'm not going to say the name in here. I'll say it later when we're in the room. That gave me pause because he was mentioning that he thinks that it was actually some, not all, not Steve or Stephanie, some of the smaller swaps desks doing some buyback of their exposure. I personally am not in love with believing that they allow themselves to get 50 e-mini points in the money and then kind of go, okay, let's start buying back. I can see them taking on a bit of risk and saying, okay, let's scalp some extra profit. But I struggle to believe that they would allow themselves to take on that much risk. I say that as someone who, as you guys know, part of the reason why I left the multi-strat was because I wanted to trade these with more risk than they were happy with me trading. And part of the risk I wanted to trade was taking delivery of my swaps and then dealing with them in the aftermarket. So I say that as someone who thinks that this is not a dumb trade. There is no way on earth I would allow myself to I would say, wow, 10, like I'm talking about 3 or 4 e-mini points I'd like to scalp somewhere after close. This is a lot of points. So my feeling is that's a lot of risk to take on. However, we cannot argue with the fact that very clearly this looks like someone driving to the exact point and turning off. And then I think it's probably more coincidental here, to be honest. But I think here there is probably some causal relationship. And so I want to say like this. I'm going to have a conversation with the individual in question. Again, I'll let you guys know. And find out what it could be. It could be a matter of them kind of saying, okay, let's take delivery of some swaps and let's see how we can, let's play some game. Let's take a small amount of risk. Maybe I could believe that. Is that enough to move the index all the way up to there? I don't think so, but you just can't argue with the fact that like we moved steadily up to it and then stopped. And, for the folks that have been in the RTM, how wildly accurate the afternoon and the morning lines are. So this looks like something we would see during market hours. So I want to say like this: my goal with streaming in the Discord was hopefully to find a way to share with folks who were already trading stuff and had signals and systems and whatever it may be that they were using, and then finding a way to incorporate what we have into theirs, right? We talk a lot about this is at best orthogonal to what you have. It's tracking a very specific thing that basically I haven't seen anyone really publicly anyway acknowledging that they're tracking. So it definitely was complementary. It can sometimes contradict, it can sometimes agree with your other signals. So that was the goal of this. So I know already some of y'all are taking the afternoon and morning lines and putting them in volume profile stuff that you trade longer term. And I think that that's great. That's really, really what I wanted. The reason why I don't do that is, frankly, I don't know how to do it. Like, I'm not smart enough to know how to do that stuff. You're smarter and better than me. And that's not false humility. I'm just saying that's what it is. So seeing this has really kind of made me think, holy shit, maybe there is something in the 5 or 10 minute period. Maybe someone really is trading the strategy that I hoped to trade with my multi-strat. And maybe they're trading it at much bigger size than I was even going to be willing to trade it at. So that's the point of this presentation here. I know a bunch of you are going to have questions. We're going to go over to the RTM room. We'll be in there all day. You'll be able to ask a million questions of me in there. I'm going to jump off now and get my formulas all done for the day. We will see you soon.
Cool. Yeah, we're open, obviously, trading 57.85. Sorry for the guys that were not able to get in. I'll put the replay in. I think there was a problem with permissions with the VSOD tag, but for some reason that overrode the everyone tag. So my apologies, but the replay will be posted. Good luck today. Obviously, pay attention to positions. I don't know what to expect, but my take is that we're not out of the woods yet. And just remember what happened yesterday. Positions are even bigger today. So Godspeed.